Time for a special Santelli exchange. Let's go to Rick in Chicago. Rick.
Thanks, John. Yes, we'd like to welcome Ed Lazear, chair of the President's Council of Economic Advisors under George W. Bush. Ed, thank you for joining me on this Jobs Thursday. We could summarize over 2 months, we created a surprising amount of jobs, just shy of 7.5 million. But if you go back to that third month, April, we were down 20.7 million. Makes sense of how we should categorize this number, especially if we're trying to hold investments or add to investments in various sectors.
Well, this is there's no negative to this number. I mean, it's absolutely amazing that we've come back so quickly. The best news about this is that it's not only the size of the number. It's not just that it's 7.5 million jobs over 2 months, but the nature of the jobs, the nature of the comeback says that we're retracing our footsteps. So if you look at the jobs that came back, those were the jobs that were lost. Over half of the jobs this month were in leisure, hospitality, and retailing. That's where the big losses were in the earlier month. And that's the sign of a healthy recovery. And the reason I say it's a sign of a healthy recovery is when you retrace your footsteps, it tells you that you don't have structural problems. There's nothing fundamental that's going on that's causing a problem. So that's good news. The other piece of good news that I would add to this is that we still have a lot of runway left. Most of the states are still nowhere near back to the levels that they were in January. That's particularly true in the Northeast, very large population states. They are still in the 40% range of coming back. The big states, California, Texas, Florida, are in the 50 to 60% range. So we've got a lot of room to grow.
And Ed, I think you just hit on the key point. You know, in our panel this morning on Squawk Box, one of the big negatives, of course, ongoing negative is that the stock market and the economy aren't exactly the same. I understand that. And to the point, we have no idea what's around the next curve with regard to coronavirus. But all things considered, states that are having problems, especially in the Northeast, as you pointed out, haven't ramped up to the extent some of the more contributing states have, which, in my opinion, gives me some solace that over the next several months, those states will pick up. And many of them, their economies are so large, the rate of change of input of jobs should improve, should it not?
Well, that's a good question. And I think the answer to that depends on what the governors do in terms of reopening. If you look at the numbers, I track foot traffic, which I think is the best indicator of how active the economy is right now. Foot traffic is about 3.5% higher this week than it was last week. So despite everything that's going on, we're still moving in a positive direction in terms of opening up. You know, of course, if the governors decide that they're going to clamp down and completely slow, then we could see, I don't think we're going to go back in the other direction, but we could see a slowing in our rate of growth over the future. The one, if you're looking for a negative, and of course, economists also always have to give you a negative. That's the nature of our personalities. So if you're looking for a negative, the continuing claims right now are predicting an unemployment rate for next month that would be not much lower than where we are right now, kind of in the 11% range, 10 to 11% range, corrected for the undercount, probably in the 12% range. So that would be the only negative that I would point out. But again, as long as we continue to open, we've got a lot of room to see a good growth in the future.
Now, Ed, when we think of what's going on with the income side, and of course the income side, the earnings side is huge. Boy, these numbers have been quite confusing. You know, if you follow year over year, they're positive, but they've been moving down. You know, going backwards, we're at 5%. Last month, we were 6.6. Prior to that, we hit the high for the cycle at 8%. Then you look at month over month, exact opposite picture. You know, we're running into the negative. Can you clarify some of the anomalies going on with the income interpretation of these reports?
Yeah, I'm not sure I can clarify it, but I'll tell you what I think is going on in the market. The market obviously looks forward. It doesn't look backwards. So what the market is doing is it's saying, look, how optimistic should we be? Is it reasonable to expect that over the next few years, we will be down only 6 to 8% from where our peak estimate was, a few months back? And that's not crazy. And the reason I say it's not crazy is that if we were to have a recovery that brought us back to February levels within the next 4 to 6 quarters, which would be good, but not impossible, from then on, we could expect that we would be back to the kinds of levels that we saw then. So the market and the inconsistency with the past numbers that you're looking at really is the difference between the future and where we've just been. So it really isn't crazy. It may be optimistic, but it's not crazy.